Options trading theory can feel like a maze of Greek letters and abstract math. Today, we are going to cut through that noise. We are going to build and execute a live trade together, step by step. Forget the old image of traders screaming on a crowded floor, hoping to guess a stock's next move. We are going to use a highly structured, risk-managed process. Your objective right now is to execute what's called a covered call. You will do this in a risk-free paper trading account, and you will build a fully logged exit plan before we even click submit. To do this, open your broker's paper trading simulator and place it on one half of your screen. On the other half, open a blank spreadsheet. This spreadsheet will serve as your trading journal. This pairing between execution and documentation creates a record of your logic. It ensures that your future decisions are based on the data you see now, rather than how you might feel once the trade is live. Start by placing a simulated order to buy exactly 100 shares of a stable blue-chip stock. Those 100 shares are the absolute requirement for a covered call. An options contract represents 100 shares of stock. By owning the underlying asset first, your position is covered. You can sell a contract safely because your downside is capped by the shares you own. Open the options chain for that stock. Ignore the massive grid of numbers and focus exclusively on the column listing the expiration dates. Scroll down and select an expiration date that is exactly 30 to 45 days from today. Options contracts have a lifespan. Every day that passes, the contract loses a little bit of its value, a metric called beta. As an option seller, time decay works in your favor, and inside that 30 to 45-day window, that decay visibly accelerates. You might be tempted to pick an expiration just a few days away to collect premium faster. Don't. Contracts with less than a week to expiration are hypersensitive to tiny stock movements. This is called gamma risk, creating violent price swings that blow past risk parameters. Targeting that specific one-month window systematically aligns time decay to generate income, while keeping the position sheltered from last-minute volatility. With your expiration date set, shift your attention to the left side of the options chain, strictly under the calls heading. Instead of guessing which strike price the stock might hit, professionals look at a metric called delta. Delta allows you to evaluate strikes based on statistical probability. Scan the delta column for a value between 0.16 and 0.30. Let's target exactly 0.20. This 0.20 delta means an 80% chance the stock won't reach this strike by expiration. The contract expires worthless, and you keep the premium collected today. Click the premium value in that row to build your order. Pause right here. Verify the action says Sell to Open. Clicking Buy by mistake is a common error that completely reverses the math of the trade. Selecting strikes based on delta replaces emotional guesswork with statistical range, establishing a repeatable, probability-based process for every trade. Before you hit Submit, locate the total credit or premium collected on your draft order ticket. We use the 50% rule for premium selling. Plan an exit the moment the trade captures half its maximum profit. If you collect a $200 premium, your target is to close the position once you secure $100 in profit. Entering any position without a predetermined exit strategy creates unacceptable risk. The plan must exist before the order is active. Go ahead and submit the order. Now, turn immediately to your blank spreadsheet and transcribe the date, the covered call strategy, your chosen strike price, the days to expiration, the total premium, and your 50% profit target. The physical act of logging these predefined targets into a journal is the definitive action that separates gamblers from disciplined traders. Look at your broker dashboard. You now own 100 cover shares, you hold one short call contract, and the cash premium has been credited to your account. Because your journal is filled out, tomorrow's actions are already decided. When the market opens, you don't have to think, hope, or panic. You simply check if your profit target has been hit. This chart shows the S&P 500's sharp downward spike on March 16, 2020. While the covered call is conservative, it doesn't make you immune to systemic crashes. If the broader market drops, the value of your underlying shares drops with it. Your assignment now is to step back and allow time decay to work on this position. Then, go back to your paper account and repeat this exact covered call process 10 more times on different stocks. Mastering this single, fully documented, and mechanically executed setup provides the critical foundation required before you ever risk a single dollar of real capital in the options market.